Hello and welcome back to the Technomentalist channel. In this video we will be looking at uranium as an investment for 2021. We believe uranium is one of the best places to have your money in 2021 through to 2025. In this video we will look at some of the geopolitical factors and the macroeconomic factors affecting the nuclear industry and the uranium industry. If you're considering investing in uranium, we believe the type of stock that you want to buy will depend on your risk tolerance, your risk profile, the size of your portfolio, and how well you can handle fluctuations. So in this video, we will touch on a large producer, an intermediate producer, and a smaller speculative stock. Recently, we have seen uranium stock prices increase. This is partly due to riding the market factors of the incredible bull market of 2020. It is also realization by the early adopters buying uranium stocks speculatively. We believe the economic fundamentals are primed for significant growth. With supply low, price low, and demand significantly increasing, it will be important to choose the right uranium stocks. Choosing the right mix of uranium stocks now could lead to multiples of 100% or significantly more to your portfolio. The geopolitical environment has shifted significantly to favor nuclear. Energy that is deemed green or has a low carbon footprint will see growth. There will be a need for a reliable, non-intermittent, pollution-free electricity source as this movement continues. There will be significant funding for a new energy transition. Political drivers like the Paris Accord, the climate change movement, and the Green New Deal will ensure this. Solar and wind will still be a good place to invest. Lots of money will be thrown there. The downside to solar and wind is its intermittent nature and limited production capacity. Nuclear is seen as being up to 20% of most countries' energy portfolio. In November 2019, the European Parliament adopted a resolution recognizing the role of nuclear in achieving its 2050 climate change plan. Nuclear power will see up to 46% growth by 2040, and 90% of that net increase may come from China, with almost 50 nuclear reactors on the books. So nuclear power capacity will be increasing steadily globally. 100 or more nuclear reactors are planned or on order or under construction. Upgrades to existing facilities will extend the life of those facilities and continue the current demand for uranium. According to our research, Morningstar expects global uranium demand to rise roughly 40% by 2025. This is coming off of an extended bear market for uranium with record low prices. So classic economics would say when supply is low, which it is due to cutbacks and mine closures in the uranium industry, price is low, currently coming out of an extended bear market. The number of suppliers is a fraction of what once was during the last boom, with almost 10% of the suppliers we once saw, and demand is increasing significantly over the next few years. So as demand increases, we expect the price of uranium to increase significantly. For current producers, this will lead to increased cash flows and profits. For the new emerging high-growth companies that will come online, we will see high profits, high growth, and even higher return on investment. So let's take a look at one of our first companies, Cameco. Cameco has strong fundamentals. They actually have enough production and control to possibly sway the market with a $5 billion market cap. Returns should be steady and relatively tied to the uranium price. They can ride this wave upwards with incredible operational cash flows should the uranium price go to where we think. Earnings are forecast to grow for the foreseeable future. They have low debt levels and are a low-cost producer. Some of the cons are their current size, market share, and production are already baked into their share price. Short-term shutdowns such as Cigar Lake and issues with various mines could affect short-term revenues and EBITDA. From a technical standpoint, their chart has positive signals with the moving averages and some caution on mid-term MACD. It is a high liquidity stock with over 2.5 million shares trading per day. This makes it attractive for short-term and swing trading. We believe Cameco is good for the long-term value investor with lower risk tolerance. Current fair value is said to be $15 to $22 a share. We believe returns could be much more than that, but not as significant as choosing one of the smaller up-and-coming producers. Next, we will look at NextGen Energy. NextGen has great assets, including the Arrow deposit, with potential to generate great cash flows. Their share price will also rise in line with uranium price increases. They have a portfolio of 10 great future projects that could generate returns. Some of the cons are that they are not currently profitable. They're going to need to raise more capital to become profitable and sustain their growth. It has neutral analyst ratings and market reaction due to share price dilution. From a technical standpoint, their chart has positive signals on the moving averages and MACD and volume. Fair share price forecast is $3.65, with some analysts forecasting up to $5.60. Current share price on the Toronto Stock Exchange is $3.26. We believe we'll see much more growth than the analysts say. We believe NextGen Energy is a good choice for people with low to medium risk tolerance, want to hold for the short to medium to long term, and want to see extremely healthy returns. We believe there are up to 10 companies that can deliver significant multiples to your investment. These companies are typically pre-production and have strong management teams, and the growth is not currently factored into their share price as heavily as the larger producers. We chose URNM as an example only. There is lots of upside growth to this company as future production is not valued into their current share price, and it can lead to higher multiples of return. They're currently trading under 50% of their estimated fair value. Revenue is forecast to grow significantly year on year, and they will benefit greatly from higher uranium prices. Some of the cons, though, include their earnings have actually declined over the last 3 years, largely attributable to a declining uranium price. Their burn rate is quite high, and they may need future capital injected into the company. There has been shareholder dilution over the last year, but we believe the price will recover and continue to grow significantly despite this. This company has a market cap of only slightly over $151 million. We believe a company fitting this profile is medium to higher risk as an investment, but could deliver significantly higher multiples of return on your investment. Fair value for this company is $1.70 on the Canadian exchange, with a current share price around 90 cents. We believe it could even outperform these estimates. Another option is to explore one of the many ETFs out there. There are several uranium ETFs that bear research, and we are providing one example for you to look at today. The ETF URA holds a good portion of significant, well-established producers, some mid-sized companies, and some speculative stocks. This would be a good choice for someone with low to medium risk who wants to benefit from increasing uranium prices and not put all their eggs in one basket by researching and choosing one or two of the producers. I hope you enjoyed this discussion of the nuclear industry, the uranium market, and a look at 2 or 3 of the different types of companies you could invest in. If you leave comments with your favorite uranium stocks, we will do a video doing a deep dive and detailed look at 1 or 2 of those. Do us a favor and hit the like button, subscribe to our channel, and follow us. We will be doing a look at the year-end 2020 and the upcoming 2021 stock market. So subscribe to our channel for more great updates. Thank you.